Managing one's finances is like a long and winding road. Carefully navigated, we try to traverse the many curves and pitfalls that suddenly appear before us. But why go it alone? Alternative Tax Management Private Client Group helps put you in the driver's seat with holistic, tax-centric planning solutions that may minimize the impact of life's greatest expense, taxes. Selling investment real estate, a privately held business, or another appreciated asset? Looking to reduce the tax exposure from high earnings, stock options, or bonus incentives? Would you like to go from tax-burdened to tax-free with your retirement assets? Get educated through our no-commitment free consultations and get connected to a carefully vetted network of financial, accounting, legal, real estate, and insurance professionals. Who's on your team? Alternative Tax Management.
Good afternoon, fellow tax strategists, and welcome to today's program on oil and gas tax strategies. We are thankful today to have Nick White join us from U.S. Energy.
Thank you, Nick. Yeah, pleasure being here. Thank you.
Appreciate having you. So we have worked quite a bit over the years with oil and gas tax strategies. It's one of those bellwether income tax mitigation or capital gains tax mitigation strategies that just seems to be a fit to layer into portfolios over the years and complement a lot of different strategies. But today we're going to focus on specifically how it can impact you from a tax mitigation standpoint in the current year that you invest. And then we're also going to discuss cash flow expectations and how they differentiate between oil drilling funds, which primarily focus on oil and have a component of natural gas that may be an offshoot of the oil wells that they're drilling. And we're also going to talk conversely about funds that focus on shale exploration and natural gas that may have a little component of oil in them. But we're going to start today with talking about some of the different purposes and different uses for both oil and natural gas. One of the things in the conversation that we have with clients and advisors is either, why do I want to invest in oil? Why do I want to invest in natural gas? These are both things that are getting phased out with environmentally sound electricity solutions or different types of energy solutions. But the fact is, these are really here to stay. And most people associate them with either gasoline for automobiles, which does create some pollution. We've gotten a lot better in both the pollution aspect with cars and also the pollution aspect in extracting these different products. I'm going to let Nick expand on that a little bit later. But if you look at the uses for these materials, it's impossible to replace the different components that these go into. Oil, for instance, if you just look around the room that you're in, it's pretty much in everything. It's in the paint, it's in the plastic, it's in the asphalt, it's in, yes, the gasoline, it's in the wax, it's in the the different lubricants that make our machinery work. And it's in the green cars that everybody, on the green side wants to promote the electric vehicles. They can't be built without petroleum. It goes into the plastic. When we look at natural gas really has been the cleaner solution to produce electricity. We started with coal being the main generator for electricity. Coal was a lot dirtier form of energy. That's also gotten a lot cleaner, but still natural gas is a much cleaner form to produce electricity. And today, natural gas is about 60%, I believe, of electricity, fuel. And of course, we use it on our stoves, and it does go into a lot of the different, components of byproducts that we use, things like feedstock and plastic and different things. So I thought we would start by talking about, just in general, how we extract these different products out of the ground and the difference between oil and shale. And I'm going to pull you and Nick to help me out with this slide. Maybe you could just run through kind of the difference between vertical and horizontal, because I know that's a big topic these days.
Yeah, I mean, when I first started in the industry 15 years ago, the majority of oil and gas was done vertically, right? And so essentially, it's exactly what it sounds like. You're drilling straight down straws into the ground, vertically into the ground, and they were cheaper to drill, but you were drilling a lot of them to try to get the production results that you would want. Right around 2009 is when horizontal drilling started to come more into play, and now it's almost 95% of what companies are doing. And essentially now you're taking one well, you're drilling 11 to 12,000 feet deep, depending on the formation. West Texas is where we have experience. And then you're drilling laterally. You're kind of going on a curve and drilling laterally for 1 to 2 miles long. So with horizontal drilling now, it's become much more efficient for companies to operate. You're drilling one well that can cover that length of 1 to 2 mile long, and your production volumes have jumped significantly. Right, that technological advancement has helped the industry out a ton, and it's a big reason why the United States is currently outpacing all-time high production. We're producing about 13.3 million barrels per day. And so that opened up a lot of new formations in the United States that we didn't have access to with vertical drilling, like the Permian in West Texas jumped significantly, because now over that 2 mile long lateral, you can operate in different stack plays within that basin. So much more production, much more volume, and much more efficient for investors in the oil and gas industry nowadays.
So if your neighbor's well is producing better, you can hit a horizontal slope and go tap into there.
Well, it's still a heavily regulated industry, right? Lease agreements and things like that. You can't drill into somebody else's lease. But you can cover a lot more ground with one individual well. And we've become so efficient in today's market that you can do multi-pad drilling, which is what most companies are doing, especially in the West Texas region, where you have one pad, right? And then you have 4 wells coming off of that pad going in different directions, or even in the same direction, spaced out. And so that's the name of the game, right? You want to be able to drill these wells as cheap and efficiently as possible, so that you can have the best margins and rate of return that investors can potentially get.
And you mentioned the western part of Texas. Most people, would recognize the term Permian Basin, which is what you're referring to, where there's literally billions of barrels of oil, right? I mean, it's one of the most oil-rich parts, not just in the country, but in the world, yes?
It is. I mean, we just talked about how the U.S. is producing 13.3 million barrels of oil per day. Roughly 8.5 of that is coming, or per day, is coming from the Permian Basin alone. Right? So it's the most active, highly productive area, most predictable and repeatable, that's what investors want, because there's different types of drilling that clients and companies can access. Maybe some of you on the call have heard of wildcatting or exploratory drilling. Some clients like that risk set. That's more of a home run or a strikeout, but the Permian is more developmental drilling. And what that means is you're operating in an area that has proven production, right? There's thousands of wells that are surrounding your acreage position. And all you're doing at that point of time is you become a big data company, right? You've taken all the results from the thousands of surrounding wells and you put it into a very tight standard deviation on what to expect. So at the end of the day, if you're doing developmental drilling or investing in a developmental drilling fund, it's much more predictable and repeatable than what you used to see back in the 80s and 90s.
I know it's not a primary focus for your company, but it is a byproduct of a lot of things that you do. Could you speak to like shale development and how natural gas could be a byproduct of some of the wells that you do for the oil?
Yeah. So, in most oil regions, very rarely are you drilling a well and it's 100% oil, right? There's not many places in the United States that have that. Now, different basins produce different volumes, right, in terms of oil versus wet and dry gas. And so when you're drilling a well in the West Texas Permian Basin area, right, the majority of your oil cut is going to come out in your first 4 or 5 years. So the majority of the revenue is coming oil first, and then post oil flush production, you're getting a lot of wet and dry gas. Like on an individual well basis, there's about 1 billion cubic feet of wet and dry gas that come out of that area. Now, there's primarily natural gas drilling, like in the Marcellus, and that's a prolific. It's one of the largest natural gas basins in the world, right here in our home, up in the Pennsylvania region. Tons and tons of natural gas up there. Those are mainly 100% natural gas wells. And essentially what you're doing there is you're drilling horizontal wells just like you would with the oil programs, and you're fracturing the shale, right? So you're sending electrical currents at very high speeds down the pipeline and fracturing the shale roughly about 1.5 to 2 feet on each side of that pipeline. And then you're pumping in water and sand at high pressure. The sand stays within those cracks and allows the natural gas or carbon byproducts to go into the pipeline and be pumped to the surface. So again, both are phenomenal, oil versus gas, oil and gas, all done here domestically within the United States.
I think it would be a stretch for us to start talking about this being, clean and green. We all know that it's not, but could you address some of the improvements? Because I know U.S. Energy in particular, I believe you guys have won some awards for just the efficiency and the more, green compared to the old versions of the oil, extraction.
Yeah, well, that whole environmental, social, and governance movement that really took head on post-COVID, and it still continues a bit today. It's subsided a bit, but it was really heavy post-COVID. It added a lot of regulations that were pretty good for the space, right? So prior to this whole environmental movement, most oil or gas companies, what they would do is what's called flaring, right? So if you're an oil company up in North Dakota and you're primarily focused on extracting oil from the ground, you would extract that oil, and then any byproduct, wet or dry gas, you would flare it, which means you would burn it off at the wellhead. And so you had all this residual, carbon output coming in from the wellhead because it was just wet gas that you weren't going to take to market, that you didn't really necessarily care about. When this environmental, social, and governance movement happened, you started to see the states fine companies that were flaring too much. Like the Texas Railroad Commission now is very concerned and tracks everything you do in terms of flaring in the state of Texas. And so what we did as a firm when we saw this come out is we spent about $40 million building out all the infrastructure and pipelines so that we can capture the gas. And so we don't flare, but we have a zero carbon output. We extract the oil, we take that to market, and we're actually putting the natural gas back into the pipeline and realizing the revenue on that as well.
Makes sense. Trying to save the environment as best as we can. We're not going to eliminate oil, but we can improve the extraction process. When it comes to tax deductions and tax benefits, we really need to hone in on capital expenditures and what I describe as startup costs that go into, establishing a large portfolio of oil wells. And that's really where the tax deduction and tax benefit passes through to the investor. Specifically speaking, it's termed intangible drilling costs. And these are costs associated with exploring and developing a well, such as hiring people to conduct surveys, clearing the ground area, building drainage, things that don't have salvage value, but not the cost for the actual pipe and the drilling equipment. And, folks often in conversation will say, all right, great. So I put my investment in place and I got the intangible drilling cost deduction and I'm getting cash flow. So when do I get my initial investment back? Well, remember the conversation about startup costs? You don't actually get your initial investment back. You get the profits that are generated through the business that you're establishing. So that's one kind of misperception about investing in oil and gas programs. As an investor in a startup business, your initial capital goes towards these intangible drilling costs, and that's why you receive a deduction on your tax return. And I've seen deductions go up to 92%. You can't write off offering expenses and different things to put together a fund, but you can write off a lot of the different costs. Typically, a shale development fund, we've seen it range from 70 to 75% in the first year, and then a carryover of another 15% maybe in the second year. And then on an ongoing basis, you're able to deduct from the cash flow a depletion allowance, which is similar to depreciation for real estate. So 15% of your cash flow is offset by the depletion allowance. Nick, so what goes into that calculation of intangible drilling costs? What makes it differentiate from year to year? And perhaps also, I was under the mindset of the depletion allowance being a set 15%, and you kind of schooled me on looking at recent K1s and things that, well, actually, it's not a set 15%. It could be altered depending on expenses. So what goes into those different calculations?
Yeah, so it really depends on the timing of drilling wells. I get the question all the time is, what makes it 85% in one year and what makes it 92% in another year? Right. So one part of it is the actual timing of wells coming online. And the biggest part is how a company is structured to cover the equipment costs, right? So there's some funds out there that will flow through the full deduction amount for general partners. And then there's another unit that will cover the equipment costs for the firm. And so essentially what you're doing is you're taking your equipment cost, having that funded by a different investment, and then allowing the full tax deduction to flow through to investors in the first year. Right. So those are the real two differentiators. The timing of wells can change your deduction, and how a sponsor firm covers the equipment cost can change your first year deduction. Now, the depletion allowance, and I've seen it on my personal K1s over the last 15 years. There, you can use the greater of cost or percentage depletion, right? So that can vary annually. The lowest it'll be is 15, but normally the cost depletion side of it is closer to 20%. And then what you can also take now, based on the 2017 Tax Cuts and Jobs Act, and it was carried forward and established permanent in the Big Beautiful Bill, is the qualified business income deduction, right? So flow-through entities can deduct a share of their business income. And so you aggregate your depletion allowance with that qualified business income deduction, like you're usually seeing between 20 and 25% of your income sheltered every single year.
So this is probably a good time to talk just briefly, not in detail, about state versus federal deductions. So the intangible drilling costs, everybody can do that on a federal level. The nice thing about the intangible drilling costs is we're going to talk on the next slide about different structures of general partner versus other share classes. But if you're a general partner, it lands on your tax return as a Schedule E business loss, which is great because it's termed an above line deduction. It's not a below line, which is an itemized deduction, which is notoriously picked away by AMT and other ways that they can eliminate your itemized deduction. Above the line means that you're really, it's hard for them to not let you take it off your gross income. But there are states like California that have really kind of taken away a lot of the state benefits. You want to comment just briefly on, varying state applications of the IDCs?
Yeah, so majority of states do allow it to apply to your state level tax. California was a big one, and that change happened last year, where they changed the state regulation and you can no longer use the deduction against your state and local taxes. A few of the others that I've noticed is New Jersey. New Jersey will not allow this to flow through to the state level return. Michigan, and then also South Carolina. South Carolina requires the partnership to be headquartered in the state of South Carolina, But those four are really the ones that we've seen where they don't allow. Usually the others are going to allow this to flow through right to your federal and state tax return level.
Are there any tricky ways around that? Can you amortize it or do anything, or have they gotten smart and wise to that?
No, the majority of them you can amortize it. California is still TBD on that because it's such a new law change. But for example, the state of New Jersey, right? You can't take the state deduction up front, but what that's going to allow you to do is amortize that over a certain period of points, usually about a 5-year period. So it's not going to be lump summed in the first year, but you can actually take that over a 5-year period, still getting a benefit, but not in the immediate 2025 calendar year.
Got it. Well, your big deduction starts on the federal level. And so hopefully most of us are in states where we can apply it. And your benefits really depend on a share class that you invest in. So US Energy in particular has been super smart about segmenting different share classes. And we're not going to talk specific programs today. But I think one of the reasons that historically US Energy has excelled at pushing through the highest intangible drilling costs was the segmentation of their marketplace into different share classes, where an LLC share class doesn't need or utilize the intangible drilling costs, so they could push those benefits into a general partner share class. So let me expand on that. So a general partner share class is the one typically used by oil and gas programs, which means you come in as a general partner, and because you're a general partner, and I'll let you comment on this in a second, Nick, you do take on certain at-risk responsibilities that allow you to pass through as somewhat of a material participant to your personal tax returns. So a general partner, you invest, you're able to receive those pass-through deductions. Again, it's an above-the-line Schedule E business loss. Limited partners built for those that want to be utilize the benefits for passive income and not active income. I'll ask you about this too, Nick, but I would guess that a vast majority are general partner, and LPs are a small component of what you're doing. And then the last share class is an LLC share class, which we love because a huge component of our tax planning strategies revolve around long-term tax efficiency of retirement assets. And an LLC share class can be purchased inside of an IRA account. And we're going to discuss that in the next slide, how that can be a meaningful discounted Roth conversion strategy. But I'll circle back to you, Nick. Maybe you could share some color on the general partner share class. We often get, the question of, well, now that I am at risk, what am I at risk for, and how do we mitigate that risk?
Yeah, so the definition of a general partner means you're at risk for more than your invested amount. And it's probably the number one question I get from clients is, what does it mean and how am I protected? Right. So the first layer of protection is when you're investing into an oil and gas drilling fund, you really want to be working with a reputable firm that has a long-term track record in doing these type of investments. That is what we call a syndicated oil and gas deal. And what that means is that in order for us to work together, right, we have to go through roughly 6 months of due diligence every single year with all the major financial institutions in the United States. Right. So they're looking at our financials, they're looking at our insurance coverages, they're looking at our track record. And then we are able to be approved to offer these investment vehicles to Jason and to clients. There's a huge swath of oil and gas firms out there that are non-syndicated, right? And that is where your risk really comes into play, meaning that, you're investing into this fund and there's additional risks that you need to take on. So for a syndicated deal, like, many of them, all that Jason has access to, go through that due diligence process. They have to carry numbers of layers of insurance that protect investors during the phase they are a general partner. Now, you're only a general partner in these type of investments for about 9 to 12 months. Once the wells are fully drilled and completed, you are converted to a limited partner from a liability standpoint, and that maintains all the way through the end of the life of the fund. But for that 9 to 12 month period that you're a general partner, there's a number of different layers of insurance. Like for US Energy example, we work with a ton of non-op publicly traded oil and gas companies. Think of Exxon, Shell, and Oxy. And so when we joint venture partner with them, they have to have their own insurance coverages. It's typically around $180 million. If anything were to get past that layer, we carry a $50 million blanket policy for investors. And then if anything were to ever get past that, we put the entirety of our company and our assets as an indemnification in front of clients, which fire sale situation, you're probably looking at an additional $350 to $400 million. So in aggregate, you have $500 million of insurance that cover you during that general partner phase. There's never been a case law in U.S. history where a syndicated oil and gas deal had clients contribute more than they invested. Going back, though, it does happen on the private side. If you're investing in Mr. and Mrs. Smith Oil and they're drilling a well in their backyard, that's inherently very, very risky.
And you guys are still in business, so I take it you've never had a blowout lawsuit that has passed through to investors.
Never. No. And especially, I mean, the type of drilling that we do, which is developmental, the area that we operate in, which is predictable, the Permian, and our experience, right? 45 years in doing these type of investments, just continue to grow. And our philosophy is predictability and repeatability, reduce risk any way we can.
Yeah. When I describe it to advisors and investors, I basically say, the first tier are those major oil operators and their assets with the $180 million insurance policy. Second tier, US Energy, $50 million insurance policy. If those companies got wiped out and actually made it to you and you were a $100,000 investor in a $750 million fund, divide your 100,000 by the 750, and that's your percentage responsibility for the liability after you blow through those other tiers. So not to make light of the fact that you are at risk, because you are, but the risk level is substantially low. So I wanted to just touch on discounted Roth conversions and the whole strategy in particular related to oil and gas, but we also do this with real estate programs where you're able to have independent third-party appraisals done by reputable accounting firms that are able to mark down the valuations of the shares for legitimate reasons. From a real estate perspective, you're able to, it's called the J curve, you're able to mark down future construction costs that you will incur over a period of time and financing charges and different things and price it into the current valuation. For oil and gas, it's lack of marketability. There's really no secondary market. You're not a controlling interest. You can't make material changes to the investment and a bunch of other expenses. I'll let Nick elaborate on it in a moment, but just looking at the philosophy of what takes place, you buy the shares inside of a self-directed IRA account. The sponsor of the program has a predetermined time that they do these independent appraisals where you're actually rooting. This is the only time you root for your value to drop. And so you're hoping that your value goes as low as possible because it's really only on paper. And as we talked about the oil and gas in particular, your initial investment really is only on paper because it has gone towards initial startup costs. Your benefit is going to be all the cash flow that's derived from the wells that you're participating in. So if we're able to mark down the value of your IRA account, what it allows us to do is convert to a Roth IRA and pay significantly less taxes on the conversion. This example just shows an initial share value of $10 to 20,000 shares purchases, 200,000 total investment. In the second year, in this example, the shares are revalued down to $6. And so that new account value drops from 200,000 to 120,000. And therefore you're paying substantially less taxes. In this example, $31,000 of tax savings. So you're starting with a 16% return just from the tax savings on conversion. Now, this is just showing a 40% decline in the valuation, which is typical for the real estate. But I've seen some of the US Energy programs range from all the way down to a 78% decline in the valuation, which is huge, because if you started with 100,000 and now you're only reporting 22,000, so you got to realize that you're not involved in the valuation process. What's happening is the independent appraisal is done by an accounting firm. That's the one step of removal. The second step is they're reporting it to your custodian, which, by the way, is not just rolling over and saying, okay, we'll just mark it down. The custodians that we've worked with, they look at those valuation reports and they might request additional information. And so there's a second tier of that fiduciary saying, okay, this makes sense. This is a reality. Now we're going to mark it down in your account. And then in January of the next year, you're getting a 1099-R, which is a redemption statement showing the new revised value. I don't know if the IRS, not that there's anything that's, done wrong here, but I don't even know that the IRS has time to backtrack and say, all right, well, they're saying that 22,000 was redeemed. Well, what did it start at? I mean, they'd have to go back and look at, all right, what did your mutual fund, what was that valued at? It's just like if your mutual fund revalued. So Nick, did I hit the main points? What do you see go into those revaluations to make them drop?
Yeah, so oil and gas is different than real estate, right? Obviously. And so how we are forced to derive the value is that it became standardized in the oil and gas space, because prior to this standardization, it was the Wild West. And so you think about Wall Street, right? And these publicly traded oil and gas companies, how they were valued was on their ability to grow their reserves, right? So it was the Wild West where one company would value their reserves point A, where another company would value their reserves point B, right? And so what you started to see is the standardization of companies being forced to value their assets on a PV10 valuation, right? So what you're doing is you're taking the present value of all of that future cash flow from that asset, and you're discounting it forward by 10%, right? So that allows you to really reduce the value on paper for an oil and gas asset in year one. Now, when you start to add in the lack of marketability and minority interest discounts that you discussed, you layer all three of those things in, and that's where you can see pretty steep discounts. And just like you said, the lowest that I've seen it in our 15 years doing this type of strategy is about 50% discounted. The highest that I've seen, it's around 78% discounted. So all of that goes in, price environment when you're doing the future cash flow valuation can affect it, but all is above board, all is within the standard, how things are standardized within the oil and gas space.
Fantastic. And then, of course, all the cash flow comes into the Roth IRA tax-free. And so you're getting the benefit of the flows of cash within the Roth structure, which is great. So, Nick, I'm going to let you kind of go through the aspect of U.S. Energy's just general strategy of partnering with the major oil companies. Maybe you could talk a little bit about that vetting process and how you formulate the portfolio each year. Congratulations on your company's growth. I know last year you guys hit like $750 million, $750 million deployed, a portfolio, of like 140 wells. And this year, you're probably going to hit $1 billion in deployed capital. So could you walk us through a little bit, not talking specifically about any one offering, but just in general, how do you vet out these partners and how do you hedge a portfolio against price risk?
Yeah, so for 35 years, we did what every other oil and gas company does. And that's, you have a family that owns that firm. They've aggregated hundreds of thousands of acres across the country, and they drop down a portion of their inventory each year and allow clients to participate alongside of them, right? And that's the majority of the space. Right around 2020, there was a massive shift, right? We all remember, hopefully we're starting to not remember, but COVID-19, right? Changed a lot of industries and different markets. And so at that time, oil prices dropped significantly, right? The world was quarantined. Nobody was traveling. Oil demand was at all-time lows, and oil pricing was around $20 a barrel. At that time, we started to field calls from publicly traded firms. Some of the names you see here, Exxon, Oxy, Shell, Devon, these are massive publicly traded oil and gas firms. They asked to start to work together in a joint venture relationship. So they saw that we were raising capital directly through advisors and clients, and we were typically raising about $400 to $500 million a year. So for them, they wanted to partner with us. It was a cheaper cost of capital for them because interest rates started to jump pretty significantly. And they were focused on increasing their dividends and reducing their debt. So for the last 5 years, we've been 100% non-operated. Essentially, what we do is we raise the $700 to $1 billion of capital, and we deploy that alongside of those publicly traded companies in their assets that they operate. And so you've seen our track record exponentially increase. We're a big firm. I've been doing this now for 45 years, but we're not the size of Exxon or Shell. And so we have the ability now to invest into institutional grade acreage positions that normally cost you billions of dollars to get access to. Our clients are getting access to that basically at cost, investing alongside of these firms. And so it's a pretty substantial process. On a quarterly basis, we review roughly $1 billion worth of deals that are brought to us from these publicly traded firms. And then we're very selective based on current prices, different commodity exposures, and return profiles of what deals that we actually close on. And so what we do is we aggregate that into a large partnership, right, where we have multiple different operators, which provides a lot of diversification, all within the same area of the Permian, but having different operators really diversifies risk from that standpoint. And even more importantly, it just high grades the returns that our clients are looking for. And so again, that's no different for 2025 and going forward. We're consistently closing on deals and partnering with those major firms.
So if I could ask you, location, we've talked about the Permian Basin, and I describe it mostly as areas that have already had proven oil exploration, that you're partnering on different sites that might be adjacent to existing sites. And you talked about wildcatting. This is not wildcatting. This is more, say straight down the fairway. What other areas outside of the Permian Basin have you guys found success or might be exploring?
Yeah, so we've drilled in over 13 states and even 2 provinces in Canada. We started out as a natural gas drilling firm all the way from 1980 to 2009. So we love the Marcellus for natural gas. It's a really good place to be from a natural gas drilling perspective. We've drilled in the Bakken. The Bakken is much more expensive to operate in because Mr. Warren Buffett owns all the railroads coming in from North Dakota. So there's no pipelines. You got to use his railroads to actually transport, and he's making a killing up there. But we've started to tap into, look at the Powder River Basin in Wyoming. It's a newer developmental field, but we've had really good results there. And so typically what we'll do is we'll put our own company capital into an area for a period of 4 to 5 years and kind of see the trend before we start even looking at potentially offering it into a partnership structure, right? We kind of go through that experience ourselves and then maybe put 3 to 5% of it in a portfolio for 1 year and continue to grow that out. But Oklahoma is really big, right? The scoop and stack play, but our primary focus has been in the Permian Basin and then a little bit up in the Powder River.
People always ask, so what risk am I taking on? Well, we talked about the general partner risk, and the other 2 risks that I highlight are price and quantity. So we kind of address the quantity in the areas that you're drilling in that are more proven wells. How do you guys address the price risk with the hedging of the portfolio?
Yeah. So prices in oil and gas tend to be a little bit volatile, right? They're priced differently. So for oil, it's globally traded, right? It follows that global supply and demand curve. The world consumes about 102 million barrels a day, and based on the supply, that's what determines price. Right? You see geopolitical events pop up, and that can affect price. Versus natural gas, it's domestically traded. So you're kind of relying on very hot summers, really cold winters, heating jumping up to fluctuate prices. So we can't control pricing fully, but what we can do is reduce the volatility. And so what we do is we hedge roughly 40 to 50% of our portfolio on an annual basis, right? We do it at the corporate level. This is free to the partnership. There's no cost. And essentially what you're doing is you're adding calls and puts on the price. And so you're creating a ceiling and a floor on your hedge. And so let's say the ceiling on a hedge is $80 a barrel WTI, and the floor, let's say, is 60. Well, if prices trade within that range, you're going to get paid on that price. But vice versa, if oil prices fall below 60, you can enact that swap with the bank, and 50% of your production is still going to get paid at that $60 mark. And so it's a way for us to mitigate risk, right? Reduce a lot of that volatility and create protections for our investors. We always hedge the amount needed from a production level standpoint to ensure, in a worst case scenario, a client returns their dollar back plus what they saved in taxes. That's kind of the philosophy.
Fantastic. So it's impossible, the next part of the conversation is, tell me year to year what my cash flow is going to be. Well, we can't do that, but I may have gotten this from you. I'm not sure. The analogy of the champagne bottle, which is, an oil well is like a champagne bottle. The beauty of it, when you combine your current year deduction with the early years fast cash flow, the oil flows really fast for the first maybe 3 to 4 years, the first 2 in particular. Then it'll plateau, and then you have a period of depletion, which could be 10 to 15 years. But it's those initial years that really output and return cash relatively quickly. And generally for drilling funds, I usually set the expectation of maybe 40 to 50% cash flow in the first 2 years. And hopefully you're tracking for 100% in the first 4, which leaves another 6 to 10 to hit a total return projection of maybe 1.5 to 2 times your initial investment. And then natural gas is a little bit different. You get the lower front end deduction, and then it starts a little bit later the next year, but typically they're expecting like a 1 to 3% distribution monthly that could go on for 25 plus years. So keep me honest, Nick, how did I do on my guidance on general cash flow expectations?
You did great. Yeah, that's perfect. And that's a real big difference, right? With oil, you're getting that dollar back very, very quickly, and your return back very, very quickly. And to me, the biggest risk in this investment is commodity price fluctuations. The faster we can get access to that money makes a lot of sense. But natural gas, you just have so much volume, right? And so you can have cash flow going to you for 25, 30 years. It'll be more steady over a long-term period. But you're exactly right, Jason. You did a great job.
Oh, thank you, Nick. I've had a little bit of practice.
Yeah, I could tell.
We do a lot of work with the oil and gas stuff. So I think the last slide in relation to just the conversation today is, who's in office now? What's going to happen next? It's kind of counterintuitive. You and I were talking before the presentation. During the Biden administration, all the folks we would talk to would say, well, why do I want to buy oil now? It's clear that they dislike it. They're not allowing for new, leases on federal lands, and they're being very restrictive. Well, I mean, look at the gasoline price and the price of oil during that period. If you're the one that owns it and selling it, it was actually a pretty good period for the owners of the oil. And then conversely, the Republican, Trump's drill baby drill comment, they have clearly loosened up restrictions and the price of oil has come down. But is there an offsetting cost that has been reduced for the extraction of oil to offset perhaps the reduced price? Nick, help us out with some comments.
Yeah, I mean, so Democratic administrations usually reduce supply, right? Add regulations, and that pushes prices higher. Versus Republican administrations, which will come in, reduce regulations, and thus reduce overall pricing. And so what you see there is that your margins don't necessarily get better just because oil prices are higher during a Republican or a Democratic administration. Your current returns can be better, but your margins don't necessarily. And so for what we've seen historically, like let's take this past administration, the Trump administration. He's come in and he's reduced a lot of the regulations. New permitting costs have dropped significantly. All the regulations, all the red tape, we like to say, has been repealed. So a well in the Permian cost us, let's say, $12 million under the Biden administration, is now costing us close to $9 million, that same exact well under the Trump administration, to actually go out and drill. Right? So that means for the same cost of capital that you raise, you can drill exponentially more wells with that same dollar, which increases your overall rate of return and has much, much better margins. That also means that your drilling costs and your break-even costs have come down as well. When oil's at $100 a barrel, your break-even costs are usually much higher because service providers are going to charge you more. Your raw material costs are going to go up. It's a supply and demand issue because everybody wants to drill at $100 a barrel. But when oil starts to retract down into that $60, $65 realm, a lot of the drilling activity tends to pause in those high cost areas, and your raw material costs and your cost to drill tend to come substantially down. And so we're loving the last year and this year because we're drilling these wells at 30% less cost to drill than we were in 2023, 2022. And so you're locking in those costs and then kind of riding that wave up when oil prices retract back to the mean, which is roughly $70 to $75 a barrel.
So when people say, when is the best time to invest in oil and gas? The answer really is every year. Because, you can't time the market with the administration, and, what you're really doing is subsidizing investment in oil and gas through the deductions that you're providing. And, if you have a choice to keep 100,000 and if you're in a 37% tax bracket, lose 37,000 to taxes, or invest 100,000 and maybe keep 33,000 in the bank because of your deduction and take the rest and put it into an income producing cash flow. It makes a lot of sense for a lot of people to do this as an annual strategy to reduce taxes and create a cash flow.
Yeah, 100%.
So we'd love to take any questions if you have any. There's a Q&A function. If you want to ask any questions of Nick or myself, we'd be happy to answer some. Aditi, thank you for your question. I think we already discussed how you select your drilling partners. If other folks want to chime in on questions, we'd be happy to address those. While we're waiting to see if there's any questions, Alternative Tax Management, thank you again for joining us today. We're a holistic tax mitigation platform where we partner with financial advisors and retail investors who are looking to reduce their income tax exposure. We have three main categories: capital transition strategies, which are focused on folks that have some type of capital gain that they might incur a taxable situation if they're selling an appreciated asset or retitling those assets, 1031 exchange for real estate, qualified opportunity zone funds, which Nick's company, U.S. Energy, has a fantastic spin on the opportunity zone fund. They're very active in that marketplace. Income tax mitigation, we talked about oil and gas today. We talked about discounted Roth conversions, and we're doing a lot with solar these years with the 100% bonus depreciation that's been returned to form by the recent tax bill. And we do have some great collateral where we can run illustrations and show you the bottom line tax result of these different programs. So if you have any questions on U.S. Energy or any of our tax strategies, we would love to have one-on-one consultations with you to discuss how these could benefit you or your clients, or if you're an accredited investor, we'd love to be working with you as well. Don't see any additional questions, and so would just like to first thank you, Nick, for joining us today.
Yeah, thank you for having me.
You're welcome, and thank you all for joining us. Please stay tuned for future events, and appreciate your time. Thank you very much.